Is it time to move your cash into fixed income? Hi, I'm Cyrus, Research Analyst at iFAST, and here with me today is 𝗪𝘆𝘀, Fixed Income Investment Director of Capital Group. Today, we'll be discussing the reasons why fixed income yields may provide a compelling investment opportunity against cash. Welcome, 𝗪𝘆𝘀, and thanks for joining us today.
Thanks, Sarah. It's a pleasure to be here.
Let's start off with the first question. So bonds are back, and this is a once-in-a-lifetime opportunity to lock in attractive yields. So is now a good time to move cash into fixed income?
Yes, Cyrus, I'd say definitely it is. I've been investing in fixed income for about 15 years now, and I can confidently say this is the most exciting time that I've seen in fixed income markets in that period. Why is that? I think there are two key reasons. One is bond yields are at levels we haven't seen in over a decade. For example, if you look at a high quality investment grade corporate bond, today that's yielding at about 5.5%. 2 years ago, that was yielding just 2%. So a huge difference. And for an investor, what that means is more income today on their investments and higher expected returns over the next 3 to 5 years from that investment. The second and really important thing is I think we're reaching a really important inflection point in financial markets. And what this means is central banks around the world are shifting from what has been one of the most aggressive rate hiking cycles to pausing and potentially cutting rates over the next few years. And this is huge. It will have significant ramifications for returns across financial markets. We've actually done some studies on this. We've looked back over 50 years of data and what happens through these inflection points when we shift from rate increases to rate decreases. And what's interesting is that we see really consistent patterns. In simple terms, we see that one, for cash, these inflection points are a really bad time. The return on cash falls away quickly. And two, for bonds, it's a really good time to enter the market. You tend to see a strong uplift in bond returns over that period.
You mentioned studies conducted using 50 years of data. So could you elaborate more on these studies, please?
Yeah, definitely happy to. So my team and I have done some detailed analysis looking back at 4 or 5 rate hike cycles over the last 50 years. So that's about as far as most data sets will go. And what we've looked at is from the point of the last rate hike in a cycle, projecting forward what happens to the returns of different asset classes during that period. So firstly, if you look at cash and you start with the point of the last rate hike and project forward 18 months, what you see is the return on cash decays quite significantly and very quickly. It drops by about 2.2% over the first 18 months after the last rate hike. So if you translate that to today's environment, say you're an investor and you have a term deposit that's paying 4% today. If we're at the peak of the cycle, 18 months from now, that 4% will have fallen to less than 2%. So your experience over the next 18 months will be not what you're expecting today. It'll be quite an unhappy experience. We then also looked at bonds and high quality corporate bonds in particular, and what you see is just the reverse. So again, we looked at the same sort of studies starting from the last rate hike, and this time projected forward over 3 years. And what you see there is very strong performance from bonds. So the bonds on average return 32% cumulatively over those 3 years. So 32% is a really strong return, even more so when you think about this being as a very defensive, high quality, lower risk asset class. And importantly, 32% is double what you would return from a term deposit or a cash-like investment over that period. So the studies I think are quite compelling. It shows this consistent pattern of cash returns decaying and bond returns getting boosted as we go through this inflection point.
That's a really interesting study. Moving on to the next question. How is your multi-sector fixed income strategy positioned to navigate the current market environments?
Yeah, it's a great question. You know, I talked about how this is an exciting time to be in fixed income markets, to enter fixed income markets today. But of course, fixed income markets are broad, and specifically where you invest matters a lot today. So as I think about our fixed income portfolios, our multi-sector income strategy in particular, there's probably 3 key elements that I would highlight. The first is diversification. It's really important to spread your bets. Don't put all your eggs into one basket. With our multi-sector income strategy, that's been designed to specifically be diversified across a range of different income generating parts of the fixed income market. So investment grade corporates, high yield corporates, emerging market debt, securitized credit, and even investments in sovereign bonds occasionally. So that gives you a real spread of return generators and provides diversification and a smoother return profile for your portfolio. If we look at our multi-sector income strategy today, what we see is that portfolio is investing across all those sectors, but tilted a bit more towards the higher quality, lower risk end of the spectrum, because we're a bit more cautious on the economic outlook. So having that flexibility is also quite important. So diversification is critical. The second one I'd talk about is balance. When you're investing for income, it's very easy to just chase the highest income yield, taking more and more risk to generate return. But that return comes with a lot of risk. You can lose your capital if you're not careful. We've constructed our multi-sector income strategy to be balanced between higher income generating bonds on the one hand, but also more defensive, higher quality bonds on the other hand. So you get a good mix of defensiveness and protection, as well as income generation. And finally, the third thing is that the individual bonds that you own matter a lot. So you can talk about investing in fixed income and the sectors that you want to go into, but ultimately you have to buy an individual bond. And to pick those bonds, research is critical. You need to have the breadth and the resources and the experience to be able to find those individual bonds. At Capital Group, we're fortunate to have a fixed income investment team of 240 people spread across the world, and their jobs are to go out and find these individual bonds that will generate good returns. So for us, I guess, if we navigating this opportunity that we see today, it really comes down to diversification, balance, and fundamental research to find those individual bond opportunities.
Thank you. It's great to hear. So 3 things: diversification, balance, and fundamental research. Great to hear that about the fund. So moving on to the more macro level, Capital Group as a whole has been managing fixed income for over 50 years. So throughout this 50 years of history, what could go wrong in fixed income investing, and what lessons have you taken away?
Well, investing in fixed income, like investing in stocks, involves risk. There are cycles that we go through, recessions, in periods of inflation, periods of deflation, lots of challenging situations that we have to navigate. We're in a very privileged position that we've had clients entrust their capital with us to shepherd through fixed income markets for just on 50 years this year. So that's given us the chance to evolve and test our process through multiple different cycles. We've actually, our 50th anniversary is this year, and recently we've been bringing together groups of current and retired portfolio managers from our fixed income group to kind of reflect back on that period and think about what lessons they've learned. And there are many, many lessons that have come out of it, but I think there are probably 2 that I would highlight today. First is the importance and the power of a coupon, a bond coupon. So a coupon in a bond is the interest payment that you receive. So that's the income you get as an investor. It's easy to forget that income, particularly over the last few years where interest rates have been near zero and that coupon hasn't been delivering much. But in today's environment, that income is back, and it's a huge contributor to the total return that you will get from an investment in any fixed income assets. So it boosts your return, and it also provides a smoothing effect against the mark-to-market volatility that you see in bond prices day to day. So that coupon is critical and should be a main focus for investing. The second point is an interesting one, I think quite unique to Capital Group, and that's the power of collaborative research. At Capital Group, all of our fixed income portfolios, all of our portfolios across the business are managed by teams, not individuals. Why do we do this? It's because investing is hard. There are lots of different variables that we need to think about. Is there a recession that's going to happen? Is the dollar going to strengthen or weaken? Is inflation increasing or decreasing? Lots of questions to answer, and it's impossible for one single person to know the answer to all of those questions. So we bring together broad teams that have different areas of expertise, and by working together collaboratively, they're able to generate the investment ideas that will give strong returns to our clients. That collaborative research process, I think, is really the magic that sits behind Capital Group's investment process.
Thank you for the insightful sharing today, 𝗪𝘆. I hope today's episode has allowed you to learn more about the investment opportunities in the fixed income space. Thank you and goodbye.
Thank you.